Welcome again to another session. And today we're going to be looking into risk management. All right, so we're going to be looking at risk management. That's what we're going to be looking at today. I'm not only going to be diving into the generality of risk management, but I'm also going to be showing you some risk management strategies that you can actually apply to your trade strategy. Now, one thing you guys must know here that every strategy has its own risk management. Okay, so you would not use the same application that you're using, the same risk management application that you're using for a certain strategy, and expect it to apply for another kind of trade strategy, right? So now, based on the trade strategy that I have already taught in this course, right? This is the risk management that we're going to use for it. Though risk management in general is same, but the strategies might not be the same. All right. So I'm going to teach you how to manage your risk. And then we're also going to look at the strategies that comes with it. So let's not waste time. Let's dive straight into it. I'm going to take an example. Of course, you know what the strategy is if you have actually watched the previous videos. And we are going to be looking at the strategy which is based on premium and discount, identifying the high and the low, and then drawing using the Fibonacci tool to actually map it out for you to give you the difference between your premium and discount. So I'm going to just go with an example that we have here. So price was somewhere around here, right? And had already printed, this low, right? So price had already printed this low. Now, based on the strategy, what we are going to do is to use our Fibonacci tool, right, to mark out this high and then mark out this low. Okay. Now, because we have identified the trend as a downtrend, so on this trend, we would only be looking for where to sell, right? So since this has printed the recent high that broke the structure of the previous low, and then at this point has printed a new low, we use our Fibonacci tool to actually identify the high and low, and then we look for point of interest within the premium zones that we can actually make our to execute our trades. Now, one of the questions that keeps popping up, right, is that a lot of traders that are using this or have been following this course will say the premium or the discount presents them with different point of interest, and they don't know which of them they would actually take a trade on, right? And that's where risk management helps you understand, or rather be prepared for to react to any of these levels that price may want to respect, regardless of if it invalidates any of the levels that you have actually looked out or mapped out that you are going to take the trade from. So when we look at this, we have several points of interest, and on most cases, I just like to go with the fair value gap, because price tends to respect it more than the other block. But in most cases, you also have to make arrangements for that. But on this case, I'm actually going to be using the fair value gap because that's what I'm actually seeing more, and price will definitely want to come and fill them up. So at this point, I have actually mapped out three. I've mapped out 3 points of interest and their fair value gaps. Now, for instance, you come into the market now, and let's say you have, let's use this as our calculator. right? Let's say you have $5,000 and you're willing to risk, you're willing to risk 1%, right? Now, before we go into that, let me quickly run through this. This course is actually a practical course. So if you don't know how to calculate, pips and all those stuff, it's very good for you to go and learn that one, because here I'm actually teaching straight on practicals, more like DIY, do it yourself, right? So if you most actually want to understand how to calculate pips, I'm going to quickly talk about that aspect like right now, so that it's going to help you understand. But it's always good for you to try as much as possible to learn this before you come. So now, let me show you how to calculate your pips, right? Because why you need to calculate your pips is because you need to identify, for you to be able to manage your risk or know the exact amount of loss side you're going to use to, actually enter this trade. You need to know the amount of pips that will now be converted into pips value for you to know how much that pips is worth in dollar, right? So if you're risking $50 and your POI shows you that you have maybe like 10 pips, you need to know how much in dollar is that pips value, that 10 pips value. You need to know how much it is in dollar, right? So that you know that, okay, if I'm expecting price to get to this point, right? Based on these pips, the 10 pips in the pips value of 10 pips is $50, right? And the loss size I'm going to use, even if I'm sleeping and price then goes and take me out, I'll definitely be losing that exact money I was willing to risk or willing to lose, which is the $50, the 1% of my $5,000. So we're going to calculate, I'm going to teach you how to calculate these pips here real quick. So how to identify the pips? First of all, this is Euro USD. 1.0683 and 8. Now, this small number you see here, right, is the pipette. And 10 pipettes makes 1 pip. So meaning that if this 7 turn 8, 9, 0, this will turn to 4, right? That's 1 pip, all right? So that's how to calculate it. So if you want to know how to calculate it, it's going to be the first digit after the four digits after your decimal point is your pips. Don't forget that that small number I just showed you, this is it here. This is the 4, right? That's it. This is the pipette. This is the pipette. So the numbers after the decimal point is your pips, and the last number is your pipette. So you would not actually deal with the pipettes, you're dealing with the pips. So if you want to calculate how much pips you have here, you would have to identify the number here, which right now I'm seeing the stop loss price is 0.921, the stop loss price. So I'll be calculating it based on 0.921 minus the entry price. Now the entry price here is 0.912. Okay, that's 9 pips. Now another way to calculate it, for those of you that may not want to go through this hassle of using the minus, no minus. Now when you draw this tool, right, you can see here above, you see number, you see stop. You see, after the stop, you see 0.0093, the 0.09%, then 9.3. That is actually the pips, the pip rather. So it is 9 pip, right? So since we actually have the idea that our stop loss is actually 9 pips from our entry, then we have to now go and calculate how much pip value in dollar is that 9 pips, based on how much we are willing to risk. So I'm willing to risk 1%, right? I'm willing to risk 1%, which is $50. So I'm expecting that if price come and touch this place, I should be looking at losing $50. Now, how do I actually put this into a mathematical calculation to actually help me know the exact price? So having said that, we've identified our pips. Now we'll go to position sizing calculator to calculate that. So this is my fxbook.com, and this is their position size calculator. So you come here, you identify the pair you're trading, which is Euro USD. Yep. The account size that we're trading is 5,000. Right now, we want to risk. You can decide to put the amount of money you're willing to risk. Like, we want to risk $50, or which of course $50 is 1%, or you can decide to use risk ratio, which is 1%. Right. However it is, the results will show you. Yeah, I'm going to show you guys anyways. So now, how much pips are we looking at? How much pips did we have there? Because based on our setup here, we expect price to actually mitigate this, react when it gets to this fair value gap, but it should not exceed above the fair value gap. Anything that actually exceeds that takes us out of the market because it's way beyond our risk, provision. But of course, we expect that price should not actually go beyond, mitigating this, and otherwise it's a failed trade, right? So we know it's 9 pips. So we come here and we impute 9. 9 pips, 1 position, and then we'll run our calculation. See the result here now, that the $50 we're willing to risk, right? In order for us to actually understand how many lot size we're going to use to be able to know that if the price hit our stop loss, we would actually lose $50. Now, based on this calculation, we've seen that the amount we're supposed to be trading in lot size is supposed to be 0.56. All right. So let me also show you, for those that may not understand the percentage. If you know how to calculate your percentage, maybe by the amount of money, you decide to say, okay, I know that 1% is $50. 1% of $5,000 is $50, but I don't want to use percentage. You can just click swap and then write $50 itself. Then having the same calculation still in place, 9 pips, 1 size position, and then you click calculate. It will still give you the same digit, but now to show you how much in percent that you're risking, right? So we've gotten this. So this is the amount of lot size that we are going to be using, right, for that trade that we want to take. So here we'll say our total lot size is 0.56 lots. Okay. So now on this account, on our 5K account, we're willing to risk 1%, which is $50. And using our position size calculator based on the amount of pips, stop loss pips that we actually identified that we're going to use here, our lot size is 0.56. Now, let's say that you had only 1 point of interest, right? 1 point of interest, then you go in all with your 1% on that point of interest. Now, in a situation where you now have, like, this setup presents 3 points of interest. Now, what is your trade, your risk management strategy, right? Because we know that price may actually get here and then reverse. Now, price may actually get here and reverse. Price may also actually get here and reverse, thereby making these two invalid, or making this one invalid, reversing here and not getting here, or making these two invalid and getting here. Sometimes it may mitigate here and then drop. This actually poses a lot of confusion when it comes to risk management for traders, because they don't know what to do at this point in time, right? And like I tell you, as traders, you need to not just predict, you need to react to the market. So you need to prepare, you need to actually create a what-if plan. So you already know that, okay, fine, price may actually get here and reverse, but what if price does not respect this zone and comes here and reacts? Now, what if price does not also respect this zone and comes here and reacts? So what is your risk management plan within the confinement of your 1%. We are going to do this. Now, we've identified this as 9 pips, right? We identified this as 9 pips. Come here also and calculate the what if for this. So we come here also, we say, okay, in case price does not respect, let us also use this. Let's also wait for price to come here in case it does not respect this first place, right? And take it down to our TP. Now, here we're actually seeing, as you can see up here, you see 9.7. So it's almost, yeah, I think this is fair to look at properly. So we expect price to be somewhere around, to not get somewhere around here. So I think also the same 9%, 9 pips, right? So now, don't forget, price is still here, dancing. This is just preparational plan to our point of interest on how we want to react once price get there. We make another, plan here that, okay, in case price actually gets to this place as well, what would be our provisional plan to react to the market, right? Each of these fair value gaps has different sizes, right? So it might not present us the same pips per stop loss, right? So on this particular one, we have 13 pips. This one, we have 12 pips. And this one, we have 10 pips. Now, how do we split this 1% to actually cover for all this, right? If it were to be the same pips, right? Let's say, for example, now we're having 13 pips here, 13 pips here, 13 pips here. So what we'll just do is, let me calculate that one for you first so that you can actually have a general understanding of how to calculate that before we go into the other part, right? So we want to know how much lot size we are going to trade with the 13 pips based on our 1% of $5,000, which is $50. So we want to know, well, we want to work with, we want to work right now as an example, right? Let's say we're working with 13 pips, right? 13 pips SL. All right, so let's say we're working with 13 pips SL for these three. So this 13, 13, 13. So what we'll do is we'll go back to our position size calculator. Euro USD, you already know this now by now, $5,000. We want to risk, I'm using percentage, 1%, and our pips is 13. Our stop loss pips is 13 pips. Now we have 3 positions. If it were to be one position, we'll be using 0.38 lot size for that one position. But as we have it right now, we have 3 positions. So at this point, we're going to put in 3. So when we click here, you'll find out that for the 3 positions based on 13 pip stop loss, we're going to be risking, we're going to be using 0.13 lot size per each of those execution we're going to be making, right? So meaning that if the total size, so if the total size for one position was 0.38, right? Total size was 0.38, right? So risking 13 pips SL times 3 positions or 3 entries would have to be 0.38 lots size, right? Divided by 3 positions, right? 3 positions, which will give us 0. I think it should be 1.3, right? Am I correct? Let me check. Yeah, which will give us 0.13 per position. So now you understand that if I want to risk $50 and I want my $50 to accommodate the losses that may be incurred in any of these, right? Meaning that if price comes here and take me out here, I lose. If price come here, take me out here, I lose. If price comes here, take me out, I lose. But at the end of the day, if I lose all this trade, I'm only going to lose $50, right? Now, we're going to calculate how much we're going to risk by each trade. Now, I'm saying this now based on the fact that everything are equal. But not regardless of that, let me just show you. So now let's take, for instance, now, yeah, let me use this setup real quick here. So for the first setup, we are going to risk. So I need you guys to help me do the maths, right? So we are risking, the SL is 13 pips for this first setup. The SL is 13 pips. And we have identified that we are going to be risking 0.13 per position. That's based on the lot size. We're going to be using 0.13 lot size per position. Now here we have a risk to reward of 1 to 524, right? We have a risk to reward of 1 to 5.24, right? Now we need to determine how much risk we are now taking. Now we remember that we are having $50 risk for this total setup. That's if we lose here, we're going to lose $50. So we want to know how much now we're risking each of them. Having divided the total lot size that could accommodate this $50 by 3 to get 0.13 per position, we will now divide the $50 by 3 positions, right? To determine how much our one risk would be to the reward that we're trying to get, right? So $50 divided by 3 will give us $16.7, right? $16.7. Now, meaning that if let me replicate this. Let me replicate this here. The risk reward for this is 1 to 1. Look at it. This is what they call risk to reward for you. Those of you that might not know, right? 1 is 7.06. So that would be 1 to 7.06, right? And we are risking $16.7. Now here, the risk reward for this is 10.5. So this is 10.5. Okay. All right. Now, don't forget that all these things are in preparation because the moment you've been able to identify your high and your low, and you have used the Fibonacci tool, you have to be preparing ahead for what price is coming to do within your point of interest, which is the premium zone. And then you identify the area of the premium zone is your area your area of interest, to say, and these fair value gaps you've identified are your point of interest. So you're waiting for price. You're preparing for when price come here on how you're going to react within your risk parameter of 1% of your total account. Okay. So now here we can see that for this first place, we are risking our SL is 13 pips. I mean, we're using 0.13 lot size for this particular position, this first position, right? And our risk to reward is 1 to 5.24, meaning that we're going to risk $16.7 to get. Now let's know how much we're going to get if price goes our way. So we're going to say $16.7 times the reward is 5.4 times 5. That will give us $88. Okay, that's reward, $88 for this place. For this second position that we're expecting price to react, we are actually risking the same 16.7, right, dollar to get 7.06 16.06 reward. So that would be 16.7 times 7.06. All right, and that will give us $118, right? Now, for this other one, we're risking the same, we're using the same 0.13 loss size for a 13 pip stop loss, and we're risking 1% to get 10.5 reward, right? So our one is $16.7 times the reward is 10.5, and that would give us $176, right? Now, the reason why your risk management strategy is very good because it keeps you well calculated. It makes you more confident in allowing your trade strategy to play out, or rather for the market to actually play out. And it gives you rest of mind because you are aware that if anything should go wrong in the entirety of this trade, I am going to lose only $50. But now, if price gets here, right, and reverses, right? Now, remember that you're only touching a fraction of your $50 now for this position. So imagine price actually gets here, right, and then goes down, right, and then goes your way to TP. Now, you only risked $16 and you got $88, right? Now, imagine price actually took you out here and then you lost $16. And on this trade, price now respected here and came down. You'll find out that you've gotten $118 that has recovered back your $16 that you lost here, right? Now, also imagine that price takes you out here and then takes you out here. Now, at this point, you realize that if price respects here, you have used your $16 again that you've kept, right, to recover back the $32 thereabouts and still got profits of over $140 thereabout. So with risk management and a very good risk to reward, you will always be in profit regardless of your losses and regardless of how the market plays out by either respecting or not respecting your initial point of interest, okay? So that's how you actually use a risk management strategy within the confinement of your risk management plan of risking 1% of your capital. All right, so now I'm going to give you an irregular calculation. I'm going to give you an irregular calculation based on the stop loss pips. So let's take, for instance, now, your stop loss here is, let's say, here is 11. Okay, we already done that already. So here is 11, here is 12, and here is 10, okay? So at this point in time, well, how do we address this now at this point in time when they are not the same? What we'll do is we'll calculate them individually, right? Now, the first thing we're going to do is to divide this by 3, which, let me take this out first. So first of all, we'll divide each position by 3. I mean, we'll divide the risk by 3 positions. And of course, we know if we divide 50 divided by 3, it's going to give us 16.6 thereabout. Yeah, approximately. It's going to give us 16.6. So now we have different tip size for each of the positions that we want to enter within this trade. So we have 3 positions we want to enter within this trade. And then we have, in these 3 positions that we have here, we have different irregular pip sizes, right? Stop loss pip sizes. So here, at this point, we're having 11. We're having 11 pips. Okay. So for this, we don't know right now. We know this is constant already. We know this, yeah, 16.7. We know our risk. We don't know, okay, we know our reward already. So we're trying to determine the lot size that we accommodate. This is our risk. All right. So, yeah. So don't forget this is 16.7 approximately. So our $50 divided by 3 positions. So we're going to say risk percentage divided by position, trade position equals risk amount per trade. Okay, so meaning our risk percentage is 1%, which is $50, and we are looking at 3 positions, 3 points of interest. So that's 3 positions if we take the trade, right? 3 positions, which will give us $16.7 per trade position, right? So per trade position. All right. So 3 trade positions. So that's the formula we're going to be working. We're going to be working with when we have different point of interest with different stop loss pips. All right. So now this first one we have 11 pips. We have a risk to reward at 1 to 5, 5.24, which is stated here. Okay, at this point in time, it's showing 1 to 6. So I need to correct that. 1 to 6.8. So it's showing 1 to 6.8. 6.08, sorry. So 1 to 6.08. So that means at this point we have to recalculate this. 1 to 6.08, right? Let me see. Yeah, 11. Here we have 12. So we have 12 stop loss pips, right? 12 stop loss pips. This we don't know yet. This we don't know yet. This is 16.7, which is our risk per position after we divided the total $50 into 3. It gave us 16.7. So we'll have to find out. Now, what is the risk to reward? This 7.6. So it's still the same thing, 7.6. For this one, the pip size here is 10. So this one is 10 pips, right? This is 10 pips. This we don't know yet. And here I think we're still working. We don't know this yet. I think we're still working with the same reward. Yeah, 10.56, right? So now we've identified that each of these positions that we're waiting for price to come so that we can react have different pips, right? Now we want to know how much is the pip value of that SL. We want it to be able to match with the amount of money we're willing to risk, so that if price, since we're willing to risk 16.7 here, if price actually touches and takes us out of the market by hitting our SL, the 11 pips value in dollar should be able to match our risk that we're willing to give out to the market, which is $16.7. So we're going to now calculate this individually. So this one now, so I'm going to say position 1. I'm going to say position 1, trade position 1, right? All right, so our trade position 1 is 11 SL. Trade position 2 is 11 pips SL for trade position 1. Trade position 2 is 12 pips SL, and that of trade position 3 is 10 pips SL. So let's go and run the calculation real quick. So we're going to go to our calculator right now, right, which is here. So Mark, don't forget this 11 pips. We're trying to calculate how much lot size we're going to use for this position, right? So first we are at here. Now, remember it's $5,000, but because of we've actually divided our percentage, our our risk, which is $50 into 3, we'll not be operating with percentage now, right? We'll be operating with the actual money, right? So now we're going to use swap. Now we're working with $16.7 for what's that? All right, so yeah. So now don't forget that the trade position 1 is 11 pips. Now we'll come here after imputing the amount into the money value, right? No, into this part, which is money instead of percentage. We're going to write the pips in 11, and now this time around is 1 position. So we run our calculation, and you see that for that particular position, based on the amount of money we're willing to risk here, which is $16, right? If this price hits the stop loss and takes us out, we're going to be losing that $16. Therefore, we're going to be using this lot size, which is 0.15 lot size, right? Now, what's our reward if this price, respects this point of interest and then hits our TP? That will now be 16.7. Let me do the capital. That will be 16.7 times 6.08, right? And that will give us $102, right? Now that's the calculation for that, right? $102. For this, we're going to run the calculation too as well. So the loss size we're going to be using for this position is 0.15. Okay, 0.15 lots. Now let's calculate for this now. So this is 12 pips, still risking the same amount. So we come here and the same capital, the same amount you're risking for that trade, but this time around is 13 pips, 1 position. You find that our loss size here is 0.13. Okay, so at this point, for the second position, we are operating with 0.13 lots. So meaning that, oh, sorry, it was a 12 pip. It was a 12 pip. So we're going to be using 0.14 instead of 13. Okay, so let me correct that. So 14 lots. So meaning that here the lot size for 12 pip stop loss is 0.14 lots. Right? Now what's our risk to reward? Since we're risking Since we're risking 16.7, so that would be 16.7. That would be 16.7 times. The reward is, don't forget, 7.06. So that would be times 7.06, and that will give us 100. That will give us $100. right? So yeah, now for this calculation, this is a 10 pips. This is a 10 pip for the third position, right? So we're going to work on the 10 pips. So we're going back to the calculator to calculate for that particular trade based on the same capital size, the amount of risk, which is $16.7 for that particular position or that particular trade on a 10 pips for one 10 pips stop loss for one position. So when we run our calculation, we have 0.17. All right. So we're going to come here and update that at 0.17 lots. Yeah, sorry about that. Okay, 0.17 lots. And here, since we've identified that 0.17 lots, right? We need to know how much is that we're going to gain. So that will be 16.7 times 10.56, and that will give us $177, right? So now you understand that regardless of each of the POIs having different stop loss pips, stop loss pips, right? We'll be able to divide our 1% into 3 to fit each of these to know the exact amount we're going to risk, equally among the 3 positions. And we have used that to determine how much each of these positions lot size we're going to be using to take the trade, and still within that particular amount of money we're willing to risk on this particular trade, which is $16.7 per each trade, but the lot size are different because of the pip size. Now, that's how you actually approach the market with a good risk management. Not only a good risk management, but a well-calculated risk management. So when they tell you understand proper risk management, or when they tell you use proper risk management, they're not telling you to just go and risk 1% of your account. When you ask traders, how do you manage your risk? You just tell you, I'm going to risk 1% of my account, but they don't know that there are strategies that you put into place to actually participate in the market at every given time or situation within that confinement of your 1%, right? So you will not say because you risk only 1% on this particular one trade, then when price comes here, you're just looking because why you lost your 1% here and you're looking at price, doing the other thing. At the end of the day, price hits one of them and then comes your way. But then you have actually, thrown all your money in the market on one position. So when you go into the marketplace in reality, you're going to go and look for a very, very good, unique product that you can buy low, or you have a product that you want to go and sell. You will not take everything and throw into the market at the first person you see at the gate. You have to try, because that may be the best offer at the point in time, but later time in the market, the market may actually present you better offers that if you actually calculate your risk very well, or your money very well, you know that, okay, even if I don't jump at everything I see at the market, I can actually anticipate things that the market may actually give me based on the pricing, and then wait to react when they come. There's nothing bad in price actually getting to this point and going your way, and you saving the remaining $32 here, right? There's nothing bad in you taking that home. I mean, at the end of the day, you still went home with about how many profits? You went home with about your $50 and $102, right? So you made the profit of $102. But if you lost this particular trade, you actually lost the second one, you will still go home, recover, you will still go home with profit, and also recover your risk here, which is about $2. And when you minus it from $177, you're still going home in profit in $140 thereabout. So at the end of the day, you're still profitable, right? And that's the core essence of what risk management and risk management strategy can help you based on your trade strategy. Now, another thing I'm going to point out here to you guys, because this is the only example I'm going to show you guys, right? I wish I could actually go more than this, but because of time, right, I'd have to stop here. So another thing you need to factor in your risk, right? You need to also factor into this your risk, you need to also understand the commission of your broker, right? If your broker is charging you $7 per lot size, $5 per lot size, $3 per lot size, however the case may be, you need to actually factor it into your risk here. If you also need to also factor your spread, your broker spread into your pips. So if your pips is 10 pips, and then you check your quotes and you see that Euro USD, your broker is giving you a spread of 3 pips. You have to add 3 more pips to this place to accommodate that, so that everything is still within your 1% of the money that you're losing, right? So I think on this note, I'll have to stop here. On the next course, I would teach you guys on something else, and it's going to be exciting.